Good morning, traders. I think we come in this morning and we saw the US equity markets were lower. It's like, oh, double take. But that's the level of cynicism that we're seeing and the expectancy that markets can only really go up at the moment. There's obviously a huge amount of momentum behind them, so I wouldn't be surprised if we did see dip buyers. But you've got to keep that eye on the Treasury market again. The ultra long end is really selling off quite sharply now. There's not really a huge amount of influence that the Fed can have over 30-year Treasuries. They can influence 7-year and into the shorter duration more readily, and I suspect we're going to start seeing that yield curve control rhetoric really ramp up now. Perhaps that's a US dollar negative, something we'll have to contend with. But certainly the idea that the back end is really moving quite sharply, and you're seeing 530 treasuries moving up to the highest spread now since 2016. Perhaps that's a reason why US banks are working so well at the moment. That's a bit of a momentum trade in the short term. If that yield curve continues to steepen, so you've got 10s and the 30-year treasuries moving up more sharply than the rest of the curve, then of course the US banks are going to do quite nicely in that situation, and growth's going to take a back seat. We're also just surprisingly seeing gold up quite sharply, up well over 1%. Silver's of a similar sort of magnitude. And I think despite what we're seeing in real yields moving up, I think this is a US dollar play. You have to then come back to what we saw from the ECB. The ECB have over-delivered. Expectations were quite high, but I think given that they've increased the PEPP programme by 600 billion euros, has beaten market expectations. They've increased the duration of that purchase programme out to June 2021. Now, if you consider that they're probably buying about 6 billion euros a day of various securities, that programme will run out by about sort of late February, early March, which means they'll probably have to increase the asset purchase programme later this year by another €500 billion or so. We know that the German Constitutional Court ruling means that the Bundesbank will probably not take part in the PSPP programme, the initial bond buying programme, at some stage soon, probably from August, which means that the PEPP programme, the new programme, the one they've just increased, will probably have to pick up the slack there and do more purchasing. So one suspects they'll need to increase that. But if you have a look at what we've been seeing in BTP spreads over German bonds in the bond market, that's narrowed by 16 basis points. Of course, Euro's going to feast off that situation. And we have also seen Euro inflation expectations moving up 6 basis points as well. EU 5-year inflation swaps have moved up by about to 107. So they look like they're testing resistance, whether or not you can use resistance levels in inflation expectations. But certainly, you are seeing that move up, and I think that's putting a bid in the euro. So euro's up now 8 days in a row against the US dollar. Can we make it a 9th day? Of course, that's one thing that we are looking at very closely. I think the last time we saw 9 days in a row of euro dollar gains was back in April 2011. So we are getting to that sort of extended point where probability is suggesting we're going to have a bit of a shallow pullback. Let's see what happens. The trigger, of course, is tonight's non-farm payrolls number. It hasn't really been a volatility event for a while, but we are looking at that more readily now. Data is going to start mattering a little bit more going forward, because people are obviously anticipating this expansion in global data flows. So I think data is going to matter a little bit more. The market's looking for 7.5 million net jobs being lost. Of course, that's a horrific number, but it is an improvement from what we saw last month. We're expecting, or certainly the market's expecting, the unemployment rate to tick up to move up to 19%. Again, another terrible number, and again, just that epitome of reconciliation between nearly record highs in the Nasdaq and a 19% unemployment rate, something we are looking at there. So if you are running US dollar positions or equity positions, do consider that could be an event risk. Perhaps not a massive volatility event, but it's an event risk nonetheless going forward. Turning to Asia, well, we're expecting a slightly weaker open given where we see SPY futures and some of the Asian equity markets there. But something we are watching there. Will people use that weakness on the open to buy the dip, or where we see people looking to come in? But of course, it's all eyes on the ECB and whether or not the euro dollar can continue to push higher from where we current junctures, or are we too overbought in the short term? We might see some profit taking. One to watch. Trade at Pepperstone.